Sorry, I was muted there. Anna Swartz-Lopez is president of Maestro Capital Solutions. She is a commercial loan broker who helps business owners and real estate investors find capital. She and her husband, Francisco, will celebrate their second wedding anniversary very soon on November 28th. They live in Vallejo and own a 4-month-old Labradoodle puppy named Star. With a little creativity, they have been keeping themselves busy through the shutdown with things like a virtual night at the opera at home or a masked, socially distant salsa party that took place in a parking lot. Visits with family, including a niece and nephew, both under 2 years old, also have been keeping her occupied. Ladies and gentlemen, Anna Swartz-Lopez.
Thank you, Rebecca, for that introduction. Just to make sure, can you guys see my screen?
There you go.
Okay, so you didn't see the pictures that Rebecca was describing for you. Okay, so there's me and my husband during COVID, being as creative as we can, and my little niece and nephew, and then my little dog in the corner. So you guys have seen this before. My company, Maestro Capital Solutions. As a loan broker, I am essentially a matchmaker between borrowers and lenders, and I work with a lot of clients who need help understanding their options when it comes to the world of business finance. And because of that, a personal credit is the foundation of any attempt to secure debt for your business. And so for today's presentation, I wanted to take some time and discuss some facts and some myths about credit. And taking my cue from Joel here, I wanted to start with a couple of cartoons. So we have a banker talking to his client, any other collateral besides your heart of gold and your $1 million smile? And then we have a couple here wondering if they can make non-fat ice cream, decaffeinated coffee, and sugarless chocolate, why on earth can't they make debt-free credit cards? Okay, personal credit. First of all, to talk about some basics. Having good credit is a lot more than paying your bills on time. There are 5 components to your credit. Payment history is, of course, just what it sounds like. And that's, of course, one component of your credit, but it's just one aspect. Another aspect is your total level of indebtedness. So how much credit do you have available and how much are you using? Your utilization ratio measures that. So for instance, if you have a line of credit at your bank for $20,000 and you're using $5,000, then your utilization ratio is 25% because you're only using 1/4 of available credit. A utilization ratio between 20 and 30% is considered very healthy. Then you have your age of credit file, or how long has your account been open. This is very important. And so for instance, I have a credit card that I've had since college that has a very low amount of credit on it, but I will never cancel that credit card because that is my oldest credit card. And if I were to close that account, that would bring down my age of credit file. So that's an aspect that I think a lot of people aren't aware of. Also important is your mix of credit. So having things, not just one type of credit on your account. So a home mortgage and a couple of auto loans and credit cards, that's a healthy mix of credit. If you're somebody who has just one credit card that you always pay on time, you will have limited credit. Even though you have a perfect payment history, you will have limited credit because with only one credit card, that's not a very good mix of credit. Also, when it comes to inquiries, too many inquiries in a short amount of time can damage your credit. On the credit profile, it shows who is making the inquiry, but it doesn't show whether you got any additional debt or not. So just think about if you're a lender and somebody comes to you and is asking for debt, and you see on their credit profile within the last 2 weeks, they have 3 credit inquiries from 3 other lenders, you, the lender, you have no way of knowing if this borrower has just taken on more debt and that additional debt is just not yet showing on their credit report. So that is why inquiries matter for your credit. Okay, now I would like to talk about 6 consumer credit myths. Consumer credit is a major part of the approval process, both when you're getting personal loans and business loans. And so here are 6 myths that people should be aware of. Myth number 1, monitoring your credit hurts your credit score. If you sign up for a service that monitors your consumer credit report, or you request your consumer credit report, a credit inquiry is placed on your credit score that shows who reviewed your report. And so this does not impact your credit score. Myth number 2, closing credit card accounts helps your score. In the past, debtors who were over their head in debt were advised to pay off their cards, cut them up, and close the accounts. While this might be the only solution for somebody who can't stop using their credit cards, however, when you close your credit account, you lower your score because you reduce your available credit. Remember, your utilization ratio is an important factor of your credit score. And if you close a personal credit account with a credit limit of $10,000, you've just lowered your available credit by that much. So a high utilization lowers your score. Myth number 3, opening a new account does not hurt my score. Opening a new account can lower your score somewhat for a short time frame. Opening up several new accounts within, say, 6 months impacts your score more. This is negative because you've taken on more responsibility and you have not yet proved an ability to pay. So new credit can impact your FICO score as much as 10%. Myth number 4, closing an account removes it from your credit report. Some think that by closing an account with negative information, it's going to be removed from your credit report and won't harm your score. This is not true. When an account is closed, it becomes part of your credit history. Your credit history is a factor in evaluating how well you pay your bills and what kind of a credit risk you are. Myth number 5 is that a credit score is the same as a credit report. A credit report is the credit data delivered in a format. A credit score is a statistical formula that's derived from that credit report. That's a summary of the information in the credit report. So think of it like your credit report is a math test and your credit score is the grade you got on the math test. And myth number 6 today is carrying a balance is good for your credit. Actually, the less you owe on your cards, the better it is for your score. Remember again here, the utilization ratio, and ideally you should only be using between 20 to 30% of available credit. It's important to treat your personal credit as an asset to your business as well as the future of your business. And I believe I am out of time here. If I have any time left, I'm happy to answer questions, but I don't